These tariffs, and I mean the market's initial reaction rather confirms this, these tariffs are basically driving the global economy into recession, slump, depression, I don't know what we'll call it. And the consequences of that, of course, are that tax revenues will disappoint, welfare costs will be higher than anticipated, government finances will take this very, very badly at a time when government finances are actually in a debt trap. Everybody's assuming that interest rates will go down. You know, the Fed will lower interest rates because they have to, and they're going to have to rescue the economy, etc. You know, it's the Keynesian playbook, but it's complete rubbish.
In today's news recap, silver price forecast. Can the market recover after its worst week since 2020? Silver posted its worst weekly performance since 2020, falling over 13% as traders grappled with deepening recession fears, forced liquidations, and a deteriorating industrial demand outlook. The sell-off reflects mounting macro stress, with trade policy under President Trump playing a central role in reshaping the demand landscape for the metal. President Trump's announcement of sweeping reciprocal tariffs and targeted measures against China triggered a reassessment of global trade flows and manufacturing prospects. Semiconductor tariffs are particularly bearish for silver, given its widespread industrial applications. China's response, slapping a 34% levy on all American goods, adds to fears of a drawn-out trade war. The result has been a sharp drop in global demand expectations, particularly in Asia and Europe, two major industrial buyers of silver. A violent decline in equities, highlighted by a 2,000-plus point drop in Dow futures, unleashed margin call selling across the board. Silver was hit especially hard as investors were forced to exit positions to cover losses elsewhere. While gold also saw liquidation, its safe haven bid helped cushion losses. For silver, with weaker monetary demand and no central bank support, the impact was deeper and more sustained. Silver's weakness was compounded by a rising U.S. dollar and an uptick in real yields. Treasury markets stabilized after strong jobs data, pushing the 10-year yield back near 3.88%. The dollar gained as expectations for aggressive Fed cuts were scaled back. Traders now turn their attention to this week's Fed minutes and Thursday's CPI report, both of which could reshape policy expectations. If the minutes signal hesitation to ease, or if CPI comes in hot, silver could face further headwinds from tighter financial conditions and a stronger dollar. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
That is a hell of a lot of investment. Now, they're not going to hang around while a bear market rages and just sort of sit on their position. No, they're going to sell it down. They're going to panic out. They're bound to. And are they going to go and buy US treasuries and corporate debt? You know, the risk-free alternative? No, as far as they're concerned, that's not the risk-free alternative. The risk-free alternative is to get into cash in their own currency, because they're running balance sheets in their own currency. If they're going to see no risk at all or minimal risk, it's got to be back into their own currency. It doesn't matter how bad the currency is. That is where the buying is going to go. And we've seen this reflected already in the dollars trade weighted, which, I mean, you look at the chart of that, it's awful. I mean, that's the only description I can give it. It fell 2% yesterday. It's like more than 2%. I mean, it's steadier today, but you know, there's no doubt, looking at the chart, that's going to go below 100. It's currently 102. Going to go below 100, and it's going to be on its way to 90. And you know, we see what happens then. I mean, allegedly, Trump wants to see the dollar lower. He's going to get his wish. But this is very, very bad news because how does the foreigner then get enticed back into the dollar? I mean, the answer is you've got to offer him an interest rate to entice him back into the dollar. You then look at the consequence of interest rates on the debt trap. And oh dear, this gets worse and worse and worse. In other words, we're getting into this sort of maelstrom, if you like, whereby everything's going round and round and round and disappearing into the black hole of nothingness. That is basically what's happening. And it's happening to the value of credit. You cannot reduce the amount of credit outstanding without banks or businesses going bust. That is the way outstanding credit gets reduced. If it's not going to get reduced that way, then it gets reduced in its value. So what will happen is that the Fed will be pushed into interest rate policies which basically destroy the dollar. And we're just in the early stages of this. And as for the commodities, this reaction actually is completely wrong. But it's understandable, being the first, if you like, the initial shock. And bear in mind also that there's still quite a bit of leverage in the US equities. I mean, if you look at the FINRA numbers, I think in February it was a short $1 trillion of debt, leverage in the market. That's getting caned, absolutely caned. So you can see that this is not good. It really is not. And first reaction to hit everything, including commodities. I think that the swaps, if you like, in gold and silver and in other commodities, the other futures commodities, are understandably trying to close down their positions. So they bash these prices, they bash them down. And of course, nobody wants to challenge them at the moment. They will manage to close some of their positions at a lower price. I don't think they will in gold. There might be some, but I mean, gold is interesting because on COMEX, there's less than 500,000 contracts outstanding, which is not an overbought situation, if you like. You don't have all these hedge funds long of gold, short of dollar. No, they're not at all. So the amount of stuff that's going to get shaken out on the bull tack, I think, is going to be disappointing as far as the swaps are concerned. Different position, obviously, in silver, because you haven't got central banks buying silver, which effectively is the backstop on gold. And on that basis, this is why silver has fallen by 6%, 6.95%. I see on my chart today, having had another very big fall yesterday. So that, I think, roughly is where we are, Jesse. It's interesting times. I see this in two phases. I see the initial shock, and then I see people looking at things a little more rationally, and then looking at the opportunities. And to my mind, the opportunities are quite simple, because it's the dollar going down. Buy commodities, buy precious metals. But it's going to take, if you like, things to settle down a little bit before people seriously consider that.
In today's news recap, gold drops sharply amid market panic, but fundamentals remain strong. Global markets opened the week under pressure, with major equity indices tumbling once again as volatility swept through the Asian session. The latest wave of selling follows China's announcement of retaliatory tariffs on the U.S., intensifying the fallout from last week's Liberation Day tariff shock. Investors had hoped that the worst of the uncertainty would fade following the initial U.S. tariff announcements. Instead, the reality has proven more severe. With tariffs exceeding expectations and no sign of negotiations, markets are now increasingly pricing in the risk of a global recession, beginning with the U.S. This risk-off mood has triggered broad-based liquidation across asset classes. Even traditional safe havens have not been spared. Gold, typically a beneficiary of risk aversion, has not been immune. XAU/USD has dropped more than 6% since Thursday, a move that seems to defy its status as a hedge during times of market stress. The likely explanation, forced liquidation. As losses pile up elsewhere, investors appear to be selling profitable or liquid assets like gold to meet margin calls or reduce exposure. As a result, this sell-off looks more technical and sentiment-driven than fundamental. The key factors that have supported gold remain intact, though. Looking beyond the short-term panic, the medium to long-term outlook for gold remains bullish. The current environment, marked by volatility, economic uncertainty, and central bank caution, typically favors gold. Last week, Fed Chair Jerome Powell reaffirmed the Fed's wait-and-see approach in response to the unfolding instability. This week's March CPI release will be crucial. If inflation data shows further softening, it could strengthen the case for future rate cuts, potentially reigniting demand for gold. On the other hand, a surprise uptick in inflation could limit the Fed's ability to ease, injecting more uncertainty into the macro picture. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
The adjustment at this stage is quite simple, and that is it's sell equities, buy bonds. But bonds are actually the wrong thing to buy. I mean, particularly where you've got duration. Don't buy duration, for goodness sake. So that's what the regulators tell investment managers to do. And anyone who passes a CTA exam knows that, the way risk works in a portfolio is the balance between equities and bonds. Commodities are never mentioned. It's just not part of the whole scene. And indeed, physical commodities are not regulated investments anyway. So, the establishment, and we're really talking about the investment establishment educated by governments and by their regulators and all the rest of it, had a very, very clear and simple response under these circumstances. And what this means is that where you got losses, basically you sell anything else in order to cover those losses. And that's what we're seeing in markets. And of course, the shorts in futures are, making hay out of it. I mean, they really are. That's why we got 7% falls today after 5% falls yesterday. But what we saw at the time of the Great Financial Crisis, I think we see again. At the time of the Great Financial Crisis, we saw gold get knocked from about $1,000. It got up to something like 1,050 or something. It got knocked from there down to about 680, and that was more, more spread out than this current episode. It took 3-4 months for that to happen. But once that was over, gold then went on up to 1920 in late 2011, because you had the knock-on effects, if you like, of the Great Financial Crisis. Particularly, you had, if you like, European debt problems and all the rest of it. Various crises in Europe, which sort of rolled and rolled and rolled, and of course everybody wanted to get out of credit and get into safety, which was really what happened. This time, I think the situation is actually far, far more dangerous. We might see the authorities trying to steady the equity market. That wouldn't surprise me at all. But look, what we're seeing is the largest credit bubble in history going pop. And it's going pop in exactly the same way as a lesser credit bubble in 1929 went pop, with combination of that and tariffs. Smoot-Hawley Mark II, I'm calling it. I think that rather like in 2000 and late 2008, the initial shock takes out everything. And then people sort of think, hold on a minute, gold is actually where we should be, not in credit, as it were. And I think we're already getting, this is not something else. This time, we got central banks doing it. Central banks are buying gold. Why? They're actually selling credit. They're getting out of paper currencies, getting out of fiat currencies. It's a big, big message which we've got to hoist on board. That is the difference between 2008 and today. And of course, they don't buy silver, which is why silver goes down. They don't buy copper, which is why copper's going down. And they don't buy oil, which is why oil and energy is sinking. But that will turn round because over long periods of time, the purchasing power of gold is very steady when it comes to buying these commodities. So, all this is pretty temporary stuff. I'm not giving a steer in terms of timing. All I will say is that the downside in gold, I think, is extremely limited, simply because central banks are standing there just picking up any loose stock they can possibly pick up. So that's going to keep things tight in gold. We have a real crisis in the markets, and that is going to lead collapsing equity values. And I wouldn't be surprised if this crash continues next week, like big time. That sort of thing begins to affect the banks because the banks have this stuff as collateral, equities as collateral. And not only that, I mentioned the leverage, around about $1 trillion of leverage. It's less than that now. I should think it's probably around about 850 to 900 billion. But on top of that, you got the commercial real estate problems and all the rest of it. I wouldn't be surprised if the next thing we see in a few weeks' time is a number of banks, if you like, being questioned about their survivability. The other thing, which is something that hasn't happened yet, is the collapse in crypto. That's going to happen. If you've only got to look at how Bitcoin correlates with NASDAQ. It's the same, or particularly the Magnificent Seven. It's the same cohort who are long of Bitcoin, who are long of those Magnificent Seven tech stocks. Watch that Bitcoin. I don't make investment recommendations, but I would not be surprised to see that as one of the best shorts at this stage in the market. So we're talking about the enthusiasm, if you like, that you get in the top of a credit bubble. It's that's evaporating. And the consequences are on values the whole way across the board.
And that's Alasdair Macleod's take on the evolving role of gold and the BRICS nations' ambitious plans to challenge the global financial order. What do you think? Do the BRICS nations' master plan for a gold-linked system hold the potential to reshape the global economy, or are the obstacles too great? Let us know your thoughts in the comments below, and don't forget to like and subscribe for more daily recaps. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.